So one of the things we like to do every year when we sit down and put our business plan together is we try to talk about what our perceptions of the world are and what our goals and objectives are. But more importantly, we as farmers are great at doing what? We're great at looking at a little yellow strip of corn and saying, what are we going to do about it? We're great at looking out at these fields and seeing a few mare's tail, and instead of just saying, well, it's a few mare's tail, we spend like weeks talking, what are we going to do about it, right? So hopefully in this presentation, I'm going to spend a little bit of time, I'm going to try to, talking about what we're going to do about both the big picture economically, about the future that Jack talks about, and about our individual farm circumstances and situations. And so, I like to kind of start out this part of the presentation talking about some of the stuff from this morning and then work into some of the more specific stuff. And yes, I will talk about the S&P. I've been asked about 5 times to do that, so I did. I went home this morning when Rodney was talking, so I hope he told you everything correctly, and changed the presentation, trying to respond better to questions that people were asking me. But I want to start out and just kind of go forward. The point of this is, what are we going to do about it? And I just want to start out with this point. When you can say that climate change is fake news, and obviously Dr. Armstrong doesn't think that way, but I think it's a good point. And one of the things that, if you look at the data that Shalimar gave us, that even in tillage environments, the cover crops are getting a lot of nitrogen out of the water. And so why in the world are only no-tillers planting cover crops? His research was done on a strip-till farm. So again, think about what Jack said. That's breaking down the norm, right? If you talk to cover crops to people, most of them, well, you got to only use that if you're no-tilling. And I don't think that's true at all. And especially as we go forward, I think these issues of nitrous oxide in the Gulf Dead Zone are going to be bigger and bigger in ag. Some of you guys know I serve on the Environmental Rules Board for the state of Indiana. Governor Pence appointed me. And I'm sitting in this meeting, and everyone in there knows the phosphorus is our problem. And IDEM, our state agency, has data on a couple of watersheds north of Lafayette that can trace 96% of the phosphorus going into the Wabash River to the farms, to the outlet tile pipe. IDEM has the data. They're not going to use it because the governor won't let them. But sooner or later, someone's going to figure this stuff out. So I think we need to be proactive about that and try to manage the future before it gets here. I've got the date on here. I just used last year's chart on this. I don't know what the number is, but global debt's just continuing to explode. We talked about this. Ag commodities are cheap. The bubble that all of us want to ignore is the land value bubble. And then a guy comes up to Jack after his presentation and says, why do we ever want to own any land? If you're going to grow all the vegetables in a warehouse in New Jersey with no dirt, why do you want to own dirt? And it's just a fair question. Obviously, dirt's always going to have a tremendous amount of value, and you're not going to produce food to feed 8 billion people in a few warehouses in New Jersey, but you will produce maybe high-value food that way. So I just want to focus again on a couple of points about this, is that we're going to have to, in agriculture, manage the bubble in land values, and if we're proactive, I think it's better than being reactive. And secondly, I think there's a lot of opportunity in this. I'm not at all depressed about land values coming down a little bit. All of us in this room that are still farming, our families have survived 4 depressions already. I don't see why we won't survive the 5th one. We're probably in arguably better shape as business people than all of our predecessors were. Oh, commodities bounce. That's the other thing about this that's important. We're in a commodity business. Commodities bounce. The guys in Minneapolis wheat just got the home run bounce. Other commodities will as well. And so part about the risk management plan, and we talked about this last night, but part of managing the risk is to recognize the risks. Jack talked about that. Be aware of what the risk is in your business and how you manage the risk. And so, for example, if you're highly leveraged and you're a young guy, you can still sell $4 December corn calls and get a dime, I think it is, right? It's never too late to sell or to buy to help manage your situation. If you're a hog feeder, boy, it sure makes a lot of sense the next week or two to be selling 360 December corn puts. geez, just make them deliver that 320 cash corn to you to go into a $70 hog. And I think that's one thing I just wanted to touch base on. We've all got to be more proactive about managing the cost structure. We have to keep pushing on our suppliers. We were talking at the break about the fact of, a new combine, so we're still running 9770s that are paid for. Cutting beans, we can cut 300 acres of beans in a day with two 9770s with 98% germ. I don't really need an S680 that costs $600,000. So again, I think I would just argue that our farm used to have old equipment, and I suspect if things keep going like they are, we're going to have a lot of old equipment around here. And probably still prosper doing it. I just think this last point here that's in red, and my bankers are here, so I got to be careful what I say. But what are you laughing at? Right there with me, thanks. But I think it's really important. So, one of the things that our business plan for 2017 or 2018 will have in it is an upfront look at what do we look like if land goes down 25%. We never put it on our financial statements at 100% of value in the first place because we knew it was going to go down at some point. But let's just say this comes completely flying apart and lands down 25 or 30%. Here's what our pro forma financial statements will look like. And Mr. Banker, Tim, buddy, good friend, love you. How are you going to feel about us at that point? Is that? But I think, making your banker aware of how stable you'll still be after that happens becomes very important, because he's not going to have anybody else walking in his office with that out in front of adversity mindset. And I think that's going to be very important for the people that survive and prosper, because any kind of volatility is going to get us all kinds of opportunities. In our personal case, we tell the story, we bought the 600 sow hog farm Christmas Eve, December 1998, and all we did was sign a document that said that we'd agree to pay them for half the inventory value. The bank wanted to write it off. They didn't have anybody that had cash, and I called up the other bank and got the cash and borrowed it. And so the point is, volatility in any business creates opportunity. You may find out that the local Napa parts store guy's bankrupt, and the bank wants to sell it, and they want to sell it tomorrow afternoon, and the franchise might cost you $10 to get the local Napa franchise. So there will be opportunities for people who are aware of what's going on, spending time on the road, talking to people, but also have the business in a place where you can make quick, snap judgments, decisions. Another thing I always put in these presentations, because a lot of people are new that don't understand this, this winter I saw no less than 20 articles about how you have to know your cost of production and use that to determine your selling price. And I've dubbed that strategy the SAP approach, which is statistically assured profitless. You're marketing like a SAP, because this is our cost structure over time. And whether or not you think that's unfair or reasonable, all the money we make doing other things, we take off our costs. So, the $100,000 we make installing tile lowers our break even. It pays for our health insurance, it pays for a few other things, but all of our costs are in the number. And so if you just look at this, how would you even dream up a system that would use your cost of production to make sales? Especially in markets that bounce. And so I just always like to throw that out there. I don't know, I know Ray Jenkins of Cargill fame might disagree a little bit with that, but for our business and the way we think about the world, we think that the person in charge of managing costs should be different than the person in charge doing the marketing. Because marketing, you want to get percent of the annual range. In this particular case, anybody with a brain would have sold it all before it even got started. And we're just saying we'll use triggers and follow up the markets as they go higher, regardless of what our costs are. This falls into another thing that Dad taught me a long, long time ago. 80% of the profits in production agriculture are in 10 to 20% of the years. And it's been that way in my lifetime too. You get 2 or 3 years, you make all the money, and you spend 4 or 5 years breaking even. So our business plan is to break even in the bad years, and with the weather that we have where we live, we get to have 3 or 4 of these moderate yield years in a row. Went home at lunch and drove back, and the beans aren't rolling over because they're mature. 5/10 in August is not enough, but we're a small part of the Corn Belt, so it doesn't matter. I always throw in the seasonal stuff. If you're young and you're not familiar with seasonal data, more research, it's real easy to get. $200. You can subscribe for 1 quarter for $80, print it all off and never print it off again. These are 30-year charts. And these don't change. The seasonals and the grains aren't going to change because they're all driven by the weather. In soybeans, you have the March low, you have the June 10th decision point. This year it's kind of muddied up a little bit with the July decision point. Almost always decline from July into August. End of August rally usually on frost, and then the collapse into harvest. Obviously, year to year that changes a lot, but it's just really good in your marketing plan to understand. If you have old corn in the bin, and we haven't had any old corn in the bin all year because we didn't think it was a great investment. But if you've got old crop in the bin on June 10th, you just need to have, any time the weekly low's broken, you need to be selling some of that because you've reached the decision point, and regardless of what you think the crop conditions are, the market's probably going to tell you. And I would argue that's because the real money, and the real money, in my worldview, are the people like ADM and Louis Dreyfus and Cargill that have their own satellites, that have their own birds, that have their own crop sensors, that have their own field scouts, that are all professionally trained. They're not extension agents going for a drive. Probably know more about the market than the speculative community does. So again, we want to include seasonals in that. Had a lot of questions about this because there are a lot of new subscribers. On any of these charts that you see that I throw up, the purple triangle is always going to be a high. Blue diamonds are always going to be times of decision. And what does that mean? Well, times of decision means that it should be very important to the market what's happening at that moment in time. And I don't have any clue what it's going to be. And most people don't. So I try to bring Jack's humility to some of this stuff and just express that this will be important. And if I knew what it was going to be, I would be in the Caribbean on a beach. And of course, the red triangles are lows. And so when you see all these numbers on the pages and the screens, those are just 3 things that could hopefully help you grasp what's going on in the charts. I like to talk about, we put together these maps of what the future should look like. And I say should in quotes. Obviously there's the disclaimer should be said, I suppose. The past performance is no guarantee of future failure. But this is last year, and this is a chart I presented last year at the meeting, and I thought we ought to have a harvest low. We ought to trade higher into the end of the year, set back into March, have a pretty nice decision point there, June 15th, and then June 30th, and then from there, weather would decide whether weather would take us up or down. And this can be pretty similar almost every year, but a lot of these arrows we put on the chart years in advance, and so for this coming year, that's the past year, so what happened? How did the future work out? And so when you look at this past year, we had the low September 1st, which of course is a few days away, rallied into harvest, rallied all the way to the first of the year. The first of the year, corn was actually at the halfway point of its annual price range. And then we had a swing high in March, and then another swing high June 15th, declined right into June 30th, shot right back up into July, and now we're going to probably just, slide lower right into September 8th. So, not perfect by any stretch, but you can kind of get a feel for what, how we can use that to our advantage in terms of, selling the old crop in early January or March. And as we go forward and look at the dates that should be important in the corn market, September 8th ought to be huge. I've been saying that for 3 months. What June 30th was. And so it's hard for me to get very pessimistic about grain prices when we're already trading a record crop. But going forward, we ought to have the same kind of this becomes kind of that seasonal chart I just showed you, right? We ought to have a recovery into the first of the year, probably a setback into March, probably a further recovery into June, and I think it'll be more bullish than anybody thinks because I just think supply and demand of corn is a lot tighter than the world wants to believe right now. And then from June 22nd, we'll either fly higher on weather or come crashing back to earth on really good weather again. We'll just see if we can grow the 7th record crop in a row is kind of the way I like to think about that. But again, these are just some dates. The stuff will be on the website. And, again, obviously it doesn't work all the time, but it helps us build a mindset. So we take that kind of information. So if we're going to have, we can't sell any corn at harvest, right? So we're not going to have any cash at harvest. We have to have a lot of cash in January. So if we rally the grain market back into the end of December time frame, we're going to want to convert a lot of the inventory to cash. Even though we think corn might be going $1 higher, we're still going to want to convert it to cash, take advantage of this kind of a recovery rally, and then on weakness, maybe buy calls or something, or maybe sell some calls, hold on to the inventory, depends on how much carries in the market. But the point being, we use this kind of a thought process to help us build a timeline in our minds for when we're going to have cash flow coming in, and when we're going to have to move inventory to get cash. We have almost all of the beans sold. The way the beans are looking, I'm pretty sure we have all the beans sold at this point on our farm. And I think the average price is pushing $10.60, $11.30 on the Cargill contracts. So we'll be pretty hesitant to play around with those because I have to have the cash in January. And yes, I think soybeans will have a nice recovery rally, but I may not want to participate. I may just want to be happy with where I'm at and hope the corn goes back up. So again, you can sense, if you think about this in the business planning perspective, we're trying to couple an expectation we have for the future with building the business plan and the cash flow to realize that. One thing, again, I mentioned yesterday, I've started putting on here these dashed lines are like the historical extremes for ownership positions. And so when you look at the corn chart, when we had the run up here July 15th, I wasn't really super excited about selling corn because nobody's playing. The funds are about half as long as they were last summer. And, because of weather, money flows, all kinds of different reasons, the open interest in corn is not very high, especially not in a commodity that has less than 30 days worth of supply, the way I calculate it. So it's just a very interesting thing that the funds did not play in corn this year. They will in the future, and there's no doubt about that. If you look back at the sugar chart that I showed you this morning, whenever a commodity gets a story, we're going to have a massive inflow of funds, and so we want to be very careful. And you guys have heard me rant and rave about not using price targets, but we want to be very careful. It wouldn't surprise me at all if this January 1st corn price is $4.50. I mean, everyone thinks the corn's great, and everyone thinks the bean crop is great. Demand is still great. We got more bins. I'm just saying the opportunity for surprises are on both sides of the equation. We're not talking about $5.50 corn where the only opportunity for a surprise is on the downside. So again, we want to wait for the timing windows to make marketing decisions. We don't like to do price targets and because we just don't know for sure where it's going to get to. We want to respond to where it gets to, and notice that we've had very limited active participation in the market for corn. I did, yeah. Yeah, so guys that were here last year and gals, remember last year we talked about how wheat should stop going down because it's just been going down forever. And of course it proceeded to go down farther and farther for 6 more months. And if you look at the wheat market, it came all the way down. It traded up for about 6 months and then traded sideways to lower for 6 months. And each of the new contracts made a new contract low when they went into delivery. Again, pretty easy money-making business to sell wheat 10 days before first notice day and cover on first notice day because it slid it back and filled. And so if you look at the similar mathematics in the corn chart, it's very possible for corn to back and fill to the first low, which is 320. And so if corn gets to 320 14 days from now, I won't be concerned or scared or pessimistic or bearish. I'll be pretty excited because we finally got it behind us. Because the people that use corn know 320 corn is pretty cheap with the S&D that we have. So that's just, and I've had that on there for the whole year because I've been trying to tell people that in my worldview, wheat leads, and wheat let itself right into the ground last March. And so for us to expect corn to take off is probably not super wise in 2017, but wheat's had a pretty big run, at least the Minneapolis have, and so it would argue, if you follow the line of reasoning, that 2018 would be corn's year, and March of 2019 would be beans' year. And then beyond that, it looks pretty pessimistic. So Well, I'm just kind of going with last year, right? We did the same thing last year. We got everybody convinced last year. So there's an awful lot of similarities to last year. The one thing that's probably not similar yet is the commercials aren't long corn yet, but this is a lagging indicator. So it might take until October 1st this year. It's going to be a harvest low, and I just don't. Maybe we just stop going down at 350 or 340 and go sideways for 6-8 weeks, or if we go all the way to 320, makes decisions really simple. So, but the other point there would be is if you have to deliver some corn at harvest, man, I think you should just sell some at-the-money calls, stop the bleeding on those bushels, and then maybe buy some calls a few weeks later. But every farm's so different. We don't really play that game because we built bins, so we don't deliver at harvest. So our thought process is converting to cash in January. And you can look back at this and maybe I should be hedged a lot of corn, and we're not. We're just going to wait and see what happens. It'll be in the bins, and we'll see where we're at in January, and we could be lower than where we are today, or we could be higher. I just like the odds of not panicking and selling 340 corn is 320 cash corn. That's awfully close to $3 cash corn. I did want to throw in we've got we always have the rules for multi-year marketing where if we get to the 0.618 of this entire range, which is this is the century-wide range in corn prices that I optimized to the mathematics. If we get to the 618, we want to start doing multi-year selling. Obviously, the 0.75 or the 0.875 is pretty easy. Got the dates on this chart. The same rhythm of time that gave us this high in 2017 gives us a much stronger high in 2018. Yes, it could be a low. Someone asked the question, why do you think it has to be a high? And really just because we've gone down so far, so fast, so long. Just statistically, expecting us to go even lower next year just requires an awful lot of good things to happen to supply. And it could, but it's kind of unlikely. So we talked last night about shifting this strategy and admitting that the bull market in 11-12 were driven by government manipulation, and talking more about in a modern world of supply and demand where we're spending so much money on productivity increases that maybe this is the right numbers to use instead of these numbers over here. And I think that's worthy of consideration for us because I become awfully pessimistic as we get out to 2020. So the bottom line is if you look at the corn market, we should have a bullish move in 2018. The odds of that are pretty high, and where it gets to by July of 2018 becomes really important. And if you look at your crop and it's burning up next July and corn's only trading at 450, that's unfortunate. But you're gonna want to take some action, even though it's only down at the first 0.618. Beans are different. There's no reason to change the numbers in beans. Still, beans are almost half of their historic price range. Obviously, the China factor is part of that. But the other side of that coin is the fact that ultimately, in the next 3 years, beans are going to trade 760. I mean, it's just a lock. I mean, every commodity in the world has come all the way back down to this level. Wheat, crude oil, are in here somewhere. So beans. I said last year they're overpriced. I don't think that mindset has cost us at all because we've been really willing to hedge beans on any rally. I think that's been the right decision. And going forward, I don't think that changes. Corn and wheat both have trickled sideways. And so what did the American farmer decide to do? Well, if we can grow enough corn and wheat to drive the price lower, let's plant another 5 million acres of beans so we can drive that price lower too. And I think that's what we've done. So somebody asked me if they should catch up selling soybeans, and I said, you got to sell some calls. Just go home, sell some calls, buy some puts, and hope you're wrong. And that's despite the fact that my crop is really frying this week. I don't think the trade's right on the bean crop. But between now and October, it doesn't have to get any better, it doesn't have to get any worse, but the odds of a rally in soybeans are a little bit lower because we already had one. People forget that, a lot of the people in this room, and us especially, made hay on this rally, right? We sold all last year's crop. We got all this year's crop sold, averaging up in there a pretty good range. So it's the approach that we take a lot of times will be really perfect in one market and not perfect in another, and that's just because we don't know the future, but we're playing statistics, and so statistically speaking, we're going to be wrong as well as be right, and it's kind of hard to remember that sometimes. This is the wheat market. So I put these charts in here so you'd have the price targets when we start talking about multi-year selling in a little bit. And you know, the bean numbers, all of us know, right? If we have 30 days of hot and dry next July, the markets are going to fly beyond comprehension because you're going to get that huge, massive flow of money in. So I don't want to, I have no idea what the price is going to get to next year. I just want to respond to it if we get the rally that I hope for. These are the wheat price ranges, and I've just reconfigured the zone, and Chicago wheat has been really lackluster. Interestingly, I don't have the commemorative traders on soybeans up, but commemorative traders in soybeans right now is actually becoming in a pretty bullish position. So the commercials are buying the dip in beans. If you look at wheat, you know, when we were over here back in March and April, you know, we have a world record open interest of commercials in the wheat market, the Chicago wheat market, and the funds were incredibly short. So it wasn't at all surprising that you would flip that over and get a big run in the wheat market. The thing that is very surprising, if you look at this chart, is despite this huge run in the wheat market, and the speculators bought almost 150,000 contracts of Chicago wheat in 3 weeks, but they didn't buy 250,000. And why didn't they? They didn't because the commercials dumped on them so hard so fast. So we had a lot of money come into the wheat market, but only got it up $1.50 because the farmer / commercial, because a lot of the hedging in wheat would be farmer selling, just tromped all over it. So the rally didn't go quite as far. I mean, I think 605 would have been a pretty easy expectation, or 685 would be pretty normal. Didn't even come close. Kansas City wheat, the same thing. The spreading between wheat classes, you know, if you look at the commitment of traders data, the biggest trading position blocks are held by unreported spreading trading. So the spreading positions in the wheats are probably very interesting if you could see the real numbers. But if you just look at what happened to the speculative participation in Kansas City wheat on that one spike up, and you see we went to a record open interest position, 75,000 long contracts. We barely got to that level back when we went from $5 to 10. And so this is what I'm getting at. We always want to remember as farmers, watch the commitment of traders data. When we get a large, long spec position, we just want to be willing to start selling. And if you look at this, if you go back over here and look at it in real time, if you do some triggers that follow the market up, you wouldn't have been selling everything at 705. You would have gotten some at 8 and some at 890 and some at 980. But once you get the specs completely committed, I think it's really important to remember that we need to shift from being optimistic and start becoming pretty pessimistic, just as a general rule of business in agriculture, because the specs are not going to buy unlimited quantities. All of them have some sort of constraints in their prospectus. And then I want to flip over a little bit. I had a lot of questions to walk through how we actually make decisions. And so I wanted to bring up the Minneapolis wheat chart. And Minneapolis wheat shows that whenever we get any kind of a story in the grain business, we're going to get a huge influx of contracts. If you notice, the open interest in Minneapolis wheat is about 40% higher than it was in 2008 when it was trading $20. So we had a huge influx of money, and of course we only made it up to 785, 790 because the commercials and the farmers just sold it all to them. And I think that represents a little bit of the fear that's going on in agriculture now, and that's why I've reduced those price targets for multi-year selling, because I think if we get back to $4.50 corn or $5 corn, I think farmers are going to jump all over it, unlike they did in 2007 and 8. So we're probably not going to get a big run to $8 just because of the psychology. I put this, Roger Neeson from North Dakota called and said, have you ever looked at Minneapolis wheat? I never had. So I just did the analysis this summer, back probably I think that was maybe in March, April. So I'd never done this work before, and you just put, so the timing bars on here, you just put the first bar at the low back in 2000, and you come over to 2008, and you get 72 months, and then you just follow it on across the different, the divisions of that. And when you do that, you can see that, very normally, after you have a big runner up like that, the quarter division, you end up being at 25% of price in the range, and you also end up being 25% in time. So the waves in time can become helpful. If you carry that analysis out, we talked about last night, the halfway point in time was a significant low in 2014, only got us a 3-month rally, and then collapsed and was broken. Slide over to the next timing point in August of 15. We actually put in the contract lows right around that. And so the rhythm and the timing is working really beautifully. You come over to the next point, which was this year in January, and you go back and look at February, you go back and look at the swing low that we had in March. You had a higher swing low at the timing point, which is a very bullish indicator because you're out of time, but you haven't gone further down in price. And so you built a case with the rapidly expanding open interest in here for Minneapolis wheat to have a nice move. And someone says, well, it's all because of weather in Minneapolis. And I said, yes. And the people that trade Minneapolis wheat for real knew about it back in January. The weather patterns were such, if you think about it, if it's going to be cold and dry in Indiana in July and August, which is what the forecast was, it was going to have to be hot somewhere. So I think people that actually use this realize that. They were positioned. The market took off. But if you look at the timing in Minneapolis wheat, the next major turn is October. Boy, I would love that to be a low so we can have the final leg up into August. I don't know if that happens or not. But we do have these two important timing points in Minneapolis wheat when looked at on a 20-year perspective. A 20-year perspective where I would point out it worked absolutely perfectly quite often in the last 15, 20 years. So it's just important to know that. And of course, it also makes it pretty hard to be a big seller in July when you're expecting a major turn in October. But I think it is really good to know that, to have it in the back of your toolbox. And if you look at where I have the pricing points for multi-year selling in Minneapolis wheat, I have the 618 of this range. So I'm not using this range over here. I'm considering that to be irrational manipulation. I know that's completely unfair, but if you just look at what's happened in the 10 years since then, this never really happened. If you look at the contracts traded, this never really happened. Most of this $3 move was on very, very few contracts of a few people bought. So we talked to Roger about this, and I called him, and so then I said, okay, well, that's the monthly analysis. This is where it's at. Back here in March and April, it's in a bullish position. This is where we're going to put the 618s. So then let's go down to monthly bars. And I just have a couple more of the dates on there. I've included the February of 2020 out here as the end of this entire time pattern is February of 2020. Those ends almost always correspond with lows. So we have this window in time in here when we could have something good happen to the Minneapolis wheat market, followed by a window in time when it should be pretty brutal. But let's just go forward. So this is the monthly chart, and then you start bringing the same kind of a thought process down to the weekly chart. And this chart gets a little bit harder to read, but I wanted to make 3 or 4 points, because when you get down to the weekly, you do the analysis all over again, and you put this blue bar. So I've got 2 different time periods being counted here at the same time. I know that's a little confusing, but we just start at the low back in the summer of 16, and we go forward, and we find out that this first leg up was 24 weeks, multiple of 12, very predictable. And we find out that we have a 12-week retracement back into April of 17. The red bars are the monthly time bars that I just showed you a minute ago, and it becomes really interesting to me that this blue bar is only designed and driven by this action here. It's not off the monthly chart. So when you look at that, you have this perfect retracement to this low over in April of 17. Why all of us weren't long 1 million bushels of Minneapolis wheat that week is beyond me, because I wasn't studying it, didn't even notice it. And then notice as the market starts to rally, we have a massive influx of money, almost 50,000 additional contracts purchased, and the market flies away. And 12 weeks later comes out to be June 30th. And on the site we talked a lot about June 30th as being a swing. We were talking about it when wheat was over here, and it ran past it by 2 days. But if you go to the next page, so now we got a weekly swing exactly on the 12-week count. And so it's pretty easy to argue that the next important swing should be September 22nd, which is 12 weeks. And obviously it looks like we're going to just slide all the way back into September 22nd. And then we get out here into December, and there's a lot of timing, and we get into the April and June of 18, and there's a lot of timing. So when we go back from the monthly chart, we've got this kind of input into the situation, and you've got an October window, which could be late September, and an August, and you go back to the weekly chart, and you have a late September, around the first of the year, and then out next summer. So you can use this to get as specific as you want, but when we're looking at building a marketing plan for Minneapolis wheat, and July 4th it touches that 0.618, I made the comment on the website that if you can't sell this year's crop because you're not sure you're going to grow it, it's a lot easier to sell next year's, and you'll still be right. And so when we take the weekly analysis, we go to the daily analysis, and you just do the same thing, only you do it in a number of days. And and people kind of maybe get tired of looking at that at this point, but the run up was exactly 60 days. Does that make any sense with 12 weeks? Right, there are 5 trading days in a week. So it kind of has to be a nice round number like that, as long as you're on multiples of 12 and 5. But it's very interesting when you go start counting the days up. And this happens a lot in weather markets, and I put this in the presentation to really stress this. If we have a weather market in one of the other classes of wheat or corn or beans or any of the ag-grown commodities like that, it's just amazing if historically you have a gap in the chart at half of the move. Not half of the move, but at an important multiple of the first leg. So you had 30 days over, and then this is day 45. And then, before it ever happened, we were really concerned about day 60 as being a high. We didn't know what price it was going to go to. I kind of thought 720 was enough, but it went all the way to 850. So, again, we don't want to try to assume how far the price is going to go, but we do want to watch for these kinds of events to be measuring events to give us indicators of where it's going. The other thing that I want to talk a little bit about is how we trigger sales, because for people that are new, that have not been around a long time, we look at 4 or 5 specific indicators that we think are very important. Commitment of traders data, are they long, are the specs long? MACD, which is the moving average, divergence, and we look at the time counts to see if we're out of time. And when we can start to see those things all come together, we start to want to start putting triggers in place to actually make sales. And so in the Minneapolis wheat, when you're in a blistering bull market that's going up 30 cents a day, and you want to sell something and you've already met what you thought would be a good place to start at, we use something so sophisticated as just the previous day's low. You'd be surprised how long that will keep you in a position. If using that this entire week right here, there was no opportunity to sell any of the wheat. Now I know the day you sold wheat 70 cents off the high, which is pretty hard to do mentally, but obviously looking at what happens in the future, it was still a good idea. So, we use the previous day's low as a trigger once we reach or pass a time point. In all the grains, if you study any of the historics in grains, when you have a first leg up and then a choppy sideways pattern and then a gap higher, you just can't fill the gap. We use that same trigger in soybeans to rehedge all the beans at 10-12. When you have a gap higher, you just can't fill the gap. Emotionally, money flow wise, you can't fill the gap after you gap higher. And why would you fill the gap here? What happened in here? This is July 15th. What happened July 15th, right? We all went home for the weekend. We had the gap on the chart. We came back. The 8 to 14 day goes cold and wet for the entire Corn Belt. And so it makes perfect sense that if you fill the gap with that set of scenarios, there's going to be some pressure on the speculatively led higher Minneapolis wheat. So again, the sales trigger in a weather market like that, if you have a gap higher and fill the gap, you sell it. It just worked in beans. It worked in the Minneapolis wheat. And the other thing that we show on here is if you take this 60-day count and go over halfway, so go over another 30 days, you get August 14th. August 14th was kind of a washout low in Minneapolis wheat after the extremely bearish report where they didn't reduce acres harvested. And so when you look at that, you could say if you were a user of wheat or if you were a hedger of wheat and you just wanted to get out of those hedges because you knew it was going to go higher again, this is a good day to do that. But importantly, when we do the roadmap in this, the low of this day has to hold. If you're going to take out that low, that means you're going to slide lower to the next timing point, which gets us all the way into September. So we'll see what happens in Minneapolis wheat. Obviously, it's washed out pretty much a lot of the whole advance pretty quickly. The other thing that the comment that we made was that, okay, so if you're scared to sell this year's crop, and you know, like I said, I mean, you know, I don't know if I can sell any more beans. I don't think I can because I don't think we're going to have them. You can sell next year's crop. And in a weather market especially, some of the best sales we've ever made. A couple of guys came up to me after the meeting last night and were saying, yeah, that's what we do. We always sell the next year's crop when we sell some of this year's. So I just pulled up, and one of the things that I spend a lot of time looking at is the deferred contract options. So, you know, it becomes really emotional to look at this year's September corn contract. If you go look at December 18 corn's contract, it's a lot less emotional. If you look at the open interest in that contract, there aren't any speculators out there. It's relatively low. It's pretty much just people that use corn and people that sell corn. It's a lot easier to study. So in the Minneapolis wheat, one of the things that we talked about was going forward, and this is the September 18 Minneapolis wheat chart. And I put the same timing dates on here, the 60 days up, and very interestingly, and this is the way it almost always works in a weather market, the deferred contract stops going up but kind of goes straight sideways. And then so if you're using any kind of your sales triggers, you sell the previous day's low, which would be over here. The gap up fails on the deferred contract. There wasn't even a gap higher to fail, but when the nearby contract gap failed, another great selling trigger, and then you can, I call that a pivot star. It's almost like a death star. You had that really bullish report or the really bullish news because it wasn't raining, and you come back the next Monday and it is. So anyway, if you just look at this, there are a lot of opportunities in the deferred contract to make a pretty good sale. And then as this stair steps down and stair steps lower, it becomes a little bit easier. So if you look at this, the quarter point in time on this chart becomes really easy to see. And so another sales trigger would be, well, if this is going to be a low, that's great. But if that low is taken out, we want to hedge. We want to be more hedged. And so you would sell more, which I know is really hard to sell 645 when it was just trading 690. But we're trying to apply some methodology to using time to our advantage. And then you come across here to the low at the 0.382 of time. And that low tried to hold and failed because of the government report. Now we've got a low here at the 0.5 in time. And notice how, despite the fact that the nearby September wheat is down, testing the low of that, the deferred is holding up. It's the kind of divergence you want to see at a market turning point. And it becomes a lot easier if you want to take hedges off as long as this low holds. But again, you can stair step the triggers as you sell more on the way down if you're going to have the crop to sell. And in the 2018 crop, I said they're selling 2017 crop first is easy. That's a typo. I did that a little too quickly a little bit ago. But it's 2018. This is a 2018 crop. And as we look at selling multiple year crops, this is the kind of strategy that we want to use. We want to build into those positions, especially in a weather market, use the triggers as the timing passes, to make those sales. And I would argue that we didn't have any of those rallies in the corn and beans this year. They really weren't weather rallies. They didn't allow us to get into that kind of emotion to make those kind of decisions. They did give us the gaps, ups, and the fails, which we used. This question is always asked, what tools do you need to sell 3 years worth of crops? And this is the kind of the place where I fall back to, you've got to work with your buyers. And you've got to develop a really good relationship with them, and you've got to have your buyer from Cargill here with her boss, right? You need to be communicating up their corporate chain, because the local buyer is going to be a young person, a professional person, and also a person that doesn't know much. Sorry. But it's the truth, right? There's no experience. So you need to include the management chain in the work, so that when you call and you set up contracts for December 2019, just so that they're on the books, that they understand what's happening. Why are you doing that? Is that your normal course of doing business? Because if you've not done that with people in the past, and you call up your local Andersons, and they're going to, why would you want to do that? Well, in our case, it's part of the strategy to have the stuff in place, so that if we get some sort of a crazy event that takes corn up to $4.80 or $5, and I just want to sell 25% of the crop, the contracts already exist. I can send an email. I want to price these contracts at this market or at this stop. You need to have it in place. But if you notice, one of the keys to this, to making this work, and I'm just going to assume we're going to have some sort of an event in the next 9 months that gives us a price run up in the corn and the beans. If it doesn't happen, we'll just have to deal with it. But what if it does happen? We want to be ready, right? You want to be ready. Like the Minneapolis wheat guys needed to be ready to take advantage of a weather event. And so, we've decided how we're going to do that. We'll do Pacer Ultras, we'll do Hedge to Arrives, with the Hedge to Arrive contract at Cargill, we can sell calls and buy puts. You'll notice that we don't use a lot of futures in the futures account here, and that's because we just don't really have the desire to manage the cash and the cash flow of having futures positions. So we want to develop relationships with buyers so that we can do some of these things. We're able to attach puts to Cargill contracts that are priced. Some people won't let you do that. Our agreement with them is if we actually grow the bushels, then we set up new contracts for those bushels, because we're selling a lot of bushels. And if you're from Missouri, right, you guys grow 120% of a crop 3 years and 40% of a crop twice, and your average is what your average is. So we never want to not fulfill a contract. We never want to have that discussion that we don't have the bushels to fill the contract. So we're trying to pick things that work for us. And so your farm's got to be completely different. You've got to talk with your buyers. You need to say, I want to set up a plan, have a plan in place, so that if something good does happen or something bad does happen, depends on your perspective, we want to be able to do this. Can I do this? But you've got to have that discussion before you get there. And having said that, this year when we had the 10-12 gap, we gapped up in soybeans and that gap failed, and we repriced all of the 17 beans. We also priced a bunch of the 18 beans at Cargill. Contracts were set up. We set up the contracts, so they're there. But those contracts will let me buy calls, so I've priced those beans, but I can unprice them. I can buy calls, and probably will make a mistake and do that. I mean, I did buy some calls on the report down day because I thought it was wrong, but obviously I was wrong. So it's just really important that you've worked with your buyers and know what they'll let you do and what they won't, and then that changes what you have to do with your plan, and it changes what you have to do with your banker. The next thing I wanted to do, again, another case study like we did with the Minneapolis wheat. There's only two bull markets, I think, in the whole commodity complex right now. One's Minneapolis wheat, which we just looked at. The other one's copper. We talked this last night about copper has some very interesting timing points coming up here right now. In terms of money flow into copper, holy smokes. Open interest is twice what it was 2 years ago, 300,000 contracts. And probably not to be ignored is the fact that China has an incredible whirligig program with using copper as collateral for bank loans, and whether the copper exists or not is quite suspect. But so there's an awful lot of money flow into copper. The timing of it, the lows we had back in 2015 kind of worked to perfection. These green bars go back from the low in 2000 up to the high and has come across, so the green timing works. And we have really important timing points in September of 17 and July of 18. You notice that almost every commodity has really important turning points in the summer of 18 and then in the spring, summer, or fall of 2020 and 2021. And a number of people have asked me, why do you think why do you think those would be highs in 2018? And it's really just a factor of kind of like copper. It went down forever, and then finally it recovered. And something will happen to give us a recovery in grain prices, and we just want to be ready for it. But if you look at this is the chart that has a number of the things that are really important to us when we start looking at doing hedging. We have a big increase in open interest. We have at the start of 2017, which was this first turn date right in here, February of 17, we have massive speculative long positions. Anybody that's in the grain business, if this was corn, you would have wanted to be hedging some corn there. Still knowing that there's some timing dates out here so the rally might continue. But everything about this is set up to warrant us looking at making hedges. And especially as we get into this month with copper getting back to the 0.618 of its range, very likely that if you're a copper producer, you should be taking hedge protection, at least on some level. So we're just going to use this as an example, call it, instead of copper, call it corn. We've got the timing points coming up. It's funny, the timing points are the same. And then you just kind of go forward to the weekly chart of copper. And this just kind of goes through the timing of the low working and going forward. And again, we've got this huge build in open interest. If you look here at the lows, we've got an exceptional amount of divergence in velocity. So that you've got the divergence on the MACD that you're looking for. And now, as we approach the September turning point in the copper, we have bearish divergence in copper. And so again, as a grain marketer, very important to realize that we have this setup of a potential high. It's a high that we want to be hedging. It's 0.618 of the range, and with a big open interest, and with the speculators getting pretty long again. So we have this basically the setup both on the monthly and the weekly chart for us to be an alert hedger. And if it's July 18 in the corn market, it'll obviously be something we want to do. So then you bring that forward to the daily chart, and of course the daily chart, it's a lot harder to see. But what do we have? On the daily chart, we also have MACD divergence. As we're making new highs, we're not making new highs in momentum. If you look at the daily chart and count the days, it's a completely different rhythm, but from this high back in 17 to the low and come forward, we have pretty good rhythmic timing points both at this first high, then August 21st, so one day before the high so far. And then these are the daily counts that come out really similar to the weekly and the monthly counts. So you have this position of market is in a period, a place where you would use timing and the price levels to your advantage to become a pretty aggressive hedger. And at this point, all we have to do is wait and see. Normally what would happen in a situation like this, which happened into the hogs as we built our totally hedged position in hogs this summer, we had a swing on the first timing point, came down, made a higher high on the second timing point and a lower high on the third timing point. And the third timing point's when they've kind of rolled over and fallen apart. So again, this is just a setup that we would go into looking at as a hedging opportunity, and as a producer of corn that's gone in price from say $3.40 right now to $4.50 or $4.80 or $5 next summer, you're definitely going to want to be alert and paying attention. You're going to implement whatever triggers you normally use to make those hedging decisions, whether it's the previous day's low, the weekly moving averages, or just sell 10% a week. But I was trying to explain how you would use time to build into a decision-making matrix to help us protect ourselves from price declines in the future. So, with that, I wanted to hopefully, when you see this stuff on the website in the future, hopefully you can understand what the diamonds and the triangles and the vertical lines mean. It's really difficult. Jack talks about what color the yield signs are, right? And I don't know about you, but I missed that. And most people miss that. It's kind of funny. But it's kind of the same thing in these things. You know, everyone's used to price retracements. Everyone's been taught their whole life, wow, look at that. That's a 50% retracement in price. Everyone's been taught that. Or everyone's been taught, well, you know, stocks are down 20% or 25%. That's a retracement in price. And so all we're really doing is putting that on its side. We're just making the retracements in terms of time, not in price. So there's no magical golden dome to that. There's just using mathematics and seeing if they'll help you learn something. And so we've been able to learn things over time that I think help us build a pretty good risk management plan. And copper sets up, it's very interesting, copper sets up for highs right now. And then if we want to take the step to the S&P, which a number of people ask about, had a number of questions last night. Well, if you don't want to be in the S&P, where do you want to be? I really think it's important to think about that as more than one market. You know, think about that as the S&P is 500. I think last week 40 of the 500 stocks made new lows. So be smarter than the average Vanguard investor. Break that out. You can roll out of the high-flying S&P components, roll into the low-flying, still have your money in the stock market, but be taking an awful lot less risk. You know, but just to kind of review, you know, the stock market obviously has been going up forever since 2009. And this is a chart that I put up there last year, and this is where it's gone. And, you know, it's real interesting because, you know, last year at this meeting we were at a really pretty awfully good expansion ratio resistant level, which is what stopped the market. And now we're exactly at the next one, almost the same week of the year. So I'm not sure what that means, but it's very interesting that the stock market has ran to 2470. It does not make it a time to buy the stock market. Obviously that was a year ago. But when you think about this is probably, in terms of a widely participated in index, it's an incredible advance. And I really think prudent management would have you roll out of some of those paper investments, no matter who you are, even if you live in New York City and you trade them all the time. Because if you look at the stock market, what does it do? It goes straight up and goes straight down. I mean, it's a very interesting phenomenon. And the other thing that's happened kind of recently, right? The Federal Reserve sort of started raising interest rates and then stopped, and Miss Yellen is kind of waffling quite a bit, which actually scares me a lot. But if they start pulling liquidity from the system, this will be the first time in about 15 years that the stock market's not been doing what the Fed says, right? The old rule is never fight the Fed. Well, the last 6 months, the stock market has been completely ignoring the Fed. So it'll be interesting to see which of those two parties wins. But yeah. Is it the same as $7 and $8 corn? Probably not a fair comparison because you've got companies actually generate dividends theoretically. But in terms of the emotional fervor and all the good news that's built in, you know, because we've already traded in the tax cuts for the rich, and we've traded in the tax cuts for the corporations, and so there's an awful lot of good news and a lot of blue sky bit into this. I mean, I don't know what Google's trading 120 times earnings or something, and Amazon is. Amazon doesn't make any money. It's kind of bizarre. So I don't know if that's a fair comparison, Brian. It's just when you couple it with the debt structure of the entire planet, it just makes for an extremely fragile. There's a great book called Anti-Fragile by Malcolm Baldwin. We've just created this bizarrely fragile international system, and unfortunately we're exporters, which would hurt from any kind of a reset. But I wanted to flip over from this. You know, again, it won't surprise me at all if the high of the entire move is 2470. The harmonics of that are extremely good, extremely good. I mean, so good I never dreamed they could get there. Yeah. Yes. What's that? Yes. Yes. Well, it's even a better. Yeah. So the question is, last year we talked about using equity values to hedge land values, and I think I think it's a great strategy. We're still doing some of it. When the market broke out into new highs, we just stopped and watched. So we invested a little bit in that strategy last year. We'll probably invest some more in it here pretty soon. But yeah, I think it's a really good strategy if it's part of your business model and part of your acumen and part of your normal course of business. I don't recommend people trading stocks, futures, if you're farmers, but in terms of the land value decline, one of the things that's really going to kick land value in the teeth would be any decline in the paper asset business. If you go back and look at 08 and 09, we had $8 corn in 08, and we imploded the stock market with it. And it took everything lower, right? Crude oil went from 140 to 25. So, I think it's a really good strategy to use. I think there are ways to do it that are relatively risk-free with buying in the money puts, and you can go out and do that in the distance. The beautiful part about this market, there's about 17 million people trading it every day, so there's a lot of liquidity, a lot of different options you can use. You can manage your risk, but still lock that in. That's the S&P. I go to the NASDAQ because it's more speculative in nature, and people, like Jack was talking about before, very few people realize that 16 months ago the NASDAQ was 4,000 and this week it's 6,000. That's a 50% increase. It's huge. So, and the other thing on the NASDAQ, I bring this up because the time on it works beautifully, and it's the speculative vehicle as opposed to the S&P 500. So all the really fast money's playing this game, although less people are playing this game than were playing it 2 years ago, which is kind of interesting. Open interest is actually declining in the NASDAQ, even though trading volume is about twice as high. So again, what we have is phenomenal speculative fervor. And if you count from the time of this high back in 2000 and count over to the low in 2009, that's 100 months down. 100 months is May of 2017, or maybe arguably June of 2017. So we have this window that we've had here on this particular graph for quite some time, where you get this window in time for a high from March to August of 2017, and you're sitting here at extremely high valuation levels with everything that you look for. One of the things that's amazing to me, if you just put a parabola on this, it's almost perfect, and it's almost vertical. Maybe not quite yet, but trading volume in the NASDAQ is 24 times the open interest, which is about 10 times higher than it is in the corn market. So again, it's just another indication of incredible speculative fervor going on, and when what you would look for if you want to be selling or hedging something. So, I think all of the stock indexes are way overvalued. It's actually one of the reasons that puts land so at risk for a decline. And that's one of those things that we want to manage and get out in front of. So yeah, I'd like the S&P. It's funny, you don't have to buy very many S&P puts to make your land payment for 1 year, which is really all you got to do, right? You just got to buy the next year. You don't have to try to hedge $10 million land portfolio and buy $10 million worth of puts. You really only have to hedge 1 or 2 years land payments to solve the liquidity problem. So it's not you shouldn't be trading 50 cars, is my point. But it's something that could be really helpful to diversify your portfolio, especially one of the guys asked for, you had the wife's 401k. Again, if you're in the Vanguard major market index funds, shift it into something else. Shift it into the oil and gas sector, which may only go down 20%. Shift it into silver mining sector that might actually go up. Shift it into something that's just not the NASDAQ-related, tech-related sector, which is so overvalued. Again, an example of how we make decisions with that. And so when you come into the NASDAQ and you've got this, you're looking for a high, you're at perfectly magical numbers, and then you come to the daily chart and you just start looking. So let's just say this is the start of an impulse leg in the NASDAQ. You can come over here and you get a certain number of days down, which I think is 18. Yeah, it's 18. And we've done this real time on the site, and it's just like it's not magic, but 18 days up is now the all-time high in the NASDAQ. 18 days later, that rhythm of emotional waves. Think about that as people who are scared, happy, and especially when the whole industry is doing it all at the same time. It was pretty easy Would have been pretty easy if you wanted to come in here on this day and sell the NASDAQ. You opened higher and then collapsed, and then you've traded sideways. And it's even easier, another repetition over, halfway through basically. There's another high. Now we've had a low, the day before yesterday, which is at the second repetition, right? So it's down, up, down, and now in the ideal world, you'd go sideways to higher for another 18 trading days, and then it just goes kablooey. That would be the normal distribution top of a massive parabolic move in any kind of a commodity. So when it happens in corn, beans, wheat, and the NASDAQ here, because it's so speculative, it's so emotional, it becomes easier to do transactions if you're looking at it this way. Massive divergence in the moving average, MACD, extremely normal for the end of a parabolic move. Which day, Jim, this day? Oh, the final date is going to be really close to September 18th, maybe 2 or 3 days off, yeah. So here again, we have this constant singularity almost, where we have possibly the last easy sell in the NASDAQ could be September 8th, which is when we might have a low in commodities. And believe me, if we're looking at these charts, people that manage billions of dollars are looking at these charts. And people are going to be, okay, commodities are so cheap, and they're seeing the same stuff. I mean, there are really smarter people than me in New York that trade billions of dollars and billions of shares that are just saying, oh, it's time for a break. So where can we put the money? So yeah, maybe they'll move some of the money over into copper, or maybe they'll move the money some over into corn. So that's I think why we get the singularity, is it's all money flow, and it's not really actual physical product supply and demand, because we've gone to a global system of unlimited speculation. Yeah.
So why does 2020 keep talking about 2020 or 2022? Why are you so pessimistic about that? Because it's going to fall?
Yeah, so the question becomes, why are you so pessimistic about 2020 or 2021? So, we had Harry Dent last year here, gives lots of speeches, pretty smart guy, obviously completely wrong, right? Because he thought the stock market was going to crash last year. I would suggest he's early, not wrong. But what you end up with is all of these markets are moving in unison because of money flow and currency creation. And so when that happens, some things still matter, though. The demographics still matter. And so Harry Dent's data still matters. Demand in the United States is going to start softening. Demand in Germany is going to fall off a cliff because of just people aging and that demographic curve of how demographics controls our spending pattern. And so those things are going on in the background. The governments are trying to overcome them by just pumping up liquidity like crazy and buying stocks and everything else that they're doing. But when you get beyond that, so I'm suggesting that maybe we can have a rally in the grains in 2018, but 2020 should kind of be when things wipe out. And if you look at the stock market and its parabolic rise and eclipse, and look at that cattle chart that we talked about back in 2014 when that happened, that collapse becomes extremely predictable. So whenever the stock market rolls over, the collapse is extremely predictable, probably 50%, and it's probably in 7 months. And see, that kind of sets up everything going down in value in 2019 and 2020. I think politically, it is awfully easy to see 2020 being a train wreck. Trump's elected in 16. After 2 years, we'll probably have a Democratic House and a Democratic Senate. So we're going to have 2 years of total screaming at each other, twiddling our thumbs while things can be unraveling. Which is kind of what happens to governments when they stop working. So I'm just suggesting that if you look at the math of it, so the other stuff is, why isn't 2020 going to be a high? I think Eddie asked me that question. Great question. It could be, but boy, a lot of things have to happen unnaturally. Okay, you have to have a marketplace where all the money flow and all the liquidity is going into stocks, and somehow it's all going to not just fall off a cliff, which is exactly what it has to do mathematically, but it's not going to so that a little bit of the money can be spilt over into commodities and drive them up. See, to make that happen, you have to have pretty rapid economic growth. And we're just not getting it. If anything, China's teetering on the edge. So Japan's teetering on the edge. A lot of pieces in Europe are going back into recession. So it doesn't make a lot of sense to stand up in front of a group of people and say, well, we're going to have a 3-year bull market in grains when the demand sector side of it is suspect and the money flow side. So that's where the 2020 lows come from. You can look at 90-year cycles. 29 is going to be 90 years ago in 18 months or 17. The other question was asked earlier that I think is interesting. Like if you're a Gone Global fan like I am, I don't follow his trading recommendations, but I like his history. In the 1950s, all of commodities just kind of went sideways, and they did. And that's why he thinks the moves are over in the grains. Are going to slide lower for 2 more years. Anything is possible, but in a system, the 50s and now are so different. And if you look back, 1948 wasn't the high in grains. 2008 was. So a lot of these cycles aren't perfect. They're more like transformations or transfigurations or slightly mirrored images of things. So you can use them to help make good decisions, but you just don't want to flatly say that, it's going to be exactly identical to 1957. Minneapolis wheat didn't rally at all in 1957. So I'm just trying to take it more, we've had these great crops back to back to back to back. It's pretty easy to see something good happening on the price side in the next 18 months. But beyond that, the global issues, the debt issues, the value of Iowa farmland, all these things can be something that could really start to become pressure-packed, especially if we have a locked-up government and a Federal Reserve that's waffling. Nobody except me seems to think it's important that she's going to raise rates and then she doesn't. Greenspan never did that. Volcker never did that. He just kept it going. So I'm a little worried about that whole thought process. So, answer the question? Yeah, thanks. I just jumped ahead to, flipped back and forth to the S&P, and if you start counting from the previous highs back in 15 in the S&P and use this as a pivot point, then the point being that you do have a pretty good harmonic time value coming in here that's just right exactly on the high, and you've got the massive divergence in open interest. It's just the classic setup for a place that you want to be a hedger, and obviously you want to be a hedger, but if we go and make new highs at this point, you don't want to be a hedger anymore. So you want to do this tactically. Don't risk $150,000, but be aware that we are at a moment in history, much like we were over in here, where we could put in a long-term high in the stock market. And one thing to watch for in this that would be just ideal, we always talk about you want to be a real big hedger, right? When we have good news and the market reacts happily and then fails. You want to be a big hedger in the grains if you have good news and the market reacts by the end of the day negatively. Same thing, whenever we pass, it'd be great if we can trade sideways to lower for 3 or 4 weeks in the stock market or even 2 months, and then we pass the tax cut package, the market rallies for 2 or 3 days and then fails. At that point, the game's over, right? Because we've just failed on good news. The stock market hasn't failed on good news in 9 years. So again, this is something to look for. Think about the psychology of it to help us make good decisions. And in terms of protecting land values, you can't hedge land futures. This stuff relative to land is bizarrely overvalued. So it's a good cross hedge that would be reported on your federal tax return as a speculative position, not as a hedge. But it's still something to consider doing as part of your business plan. The last thing that's interesting to me that kind of helps reinforce this a little bit is the bond market, which of course has gone straight through the roof for a long time as well, because we're going to take rates to zero because we can't afford to pay for money anymore. The bond market's got a real nice 6-quarter little rhythm going to it. The fourth quarter of 2017 would be the next. We've had the first kind of a down scare here, and now we're building back up. And if the stock market rolls over and we have a couple of scary days, what's going to happen to U.S. bond prices? It's a lot like what happens when North Korea threatens to blow something up, right? The bonds go up for a point or two, and then they'll settle back. But if the stock market rolls over, the bond market's probably going to have a really good week or 2 weeks, be up 10 or 15 points probably in the face of all that adversity, and possibly put in a beautiful head and shoulders top here in the fourth quarter of 2018 before people realize we can't actually pay off any of those bonds. It's not a good time. The point is, we've talked a lot about over the years about hedging interest rates. It's really not a good time to be hedging interest rates, because we should have this recovery rally back as the stock market starts to get in trouble, because money has to go somewhere, and this is a huge market. People kind of lose track of the fact. I think the bond market is 10 to 20 times the size of the stock market globally. So it's probably the biggest game in town, so money can easily move there. So I hope I hit the target of kind of walking through the decision-making process a little bit and walking through the thought process of how we're going to try to manage the risk in the business. Probably the biggest operative word on that is, we're going to really come after any kind of rallies we get in the grains. We have all the hogs hedged for the next 18 months. We're going to keep them all hedged and just pray that we're wrong. We're doing that, as we talked in the past, with in-the-money puts. You have to have the cash to buy them, but the delta is really good. If you don't understand some of those terms, you give Brian or Jordan a call. That's who we work with, and they'll help you with that. Somebody asked if I use Trade Navigator to place trades. I do not. I love the software package because I can do all this stuff real easily. But I still like trading with Brian and Jordan, because we basically, they're willing to accept orders to do things if certain things happen. And that's really hard to put into a Trade Navigator order, But I think for us, it makes a lot of sense. I think of when beans gapped above 10.12 and then failed, we had orders in to get out of all of the long stuff we had there, the bean meal, and I just told them, if we fill the gap, get out. So that's not really a legal order, but they're really good to work with, and they'll help me if we want to buy or sell calls or options against inventory. They help me figure out which option is the best one to accomplish what we're trying to do. So I like working with people that are experts in options and volatility and all of those things. But they're more expensive, obviously, than just putting it on Trade Navigator. So Trade Navigator is not that hard to get. It doesn't take that much bandwidth. And I just find it to be a really nice source, because I can do weekly, monthly. Just one click, you jump from the weekly to the monthly, one click to the daily, one click to the 5-minute bar charts, and all this tools follow it along. So, and that's kind of what I put together. I tried to answer a lot of the questions. Some people would want to know maybe like when's the next swing in soybean prices, and that's one of the charts we talked about this morning. But reality is we're going to probably have a big crop apparently. If we have the big crop, then we're going to have a very seasonal marketplace, very likely. No one's talking about it yet, but La Nina is back, and the La Nina is bad for yields. It can't be both good and bad, right? Because El Nino is supposed to be good for yields. So, but La Nina is back and developing very quickly, kind of as a surprise to most of the meteorologists. So maybe we've got some hope for 18 being a little scary. We don't enter the winter with full subsoil profiles, at least not yet, that we had last year. So the things are changing slowly. But a lot of things open up there to a very seasonal kind of year, which would give us rallies into the wintertime. And then we get the acreage numbers and setbacks, and then maybe we get to some weather next summer. So questions? Usually, hopefully I didn't miss anything too major. Before we all leave, I need to thank my family. It's really funny. If I'm putting this together, I'm not washing the walls, right? And so Stephen and Nick and Neil and all those guys, and Caleb and Claire and Jane and the whole crew has done a great job pulling this together for us, and we all appreciate you coming out and supporting us, and we just really enjoy the interaction. So anything else? It has been a joy having you guys here, and we will look forward to next year, and we'll look forward to some, hopefully, things moving in our direction. Thank you.